You want to get started, or?
Yeah, we'll just go ahead and start with the intro. I know this typically happens. A couple people keep filing, and that's fine. We're recording the session, so anyone who's unable to make it today can refer back to it. We typically post everything within 24 to 48 hours after the webinar, so it'll be up and available for everyone to refer back to.
Sounds good.
So for those of you that are here, my name is Crystal. I am the Director of Marketing and Social Media here at Coester Appraisal Group, and we want to thank you all for being here with us today. You all are in for a treat. We do have a guest speaker, Tracy Becker from North Shore Advisory Incorporated, who's here to give us a little bit of insight as to how to prepare your clients' credit portfolio to put them in the best light and make sure that you have successful business. So I'll go ahead and pass everything over to Tracy to give you a little bit more about her background. And just a couple of things before I do that. We are once again recording the session for anyone who wasn't able to attend today. It will be posted on our website within the next 48 business hours. So please stay tuned for that, and we will send out a link directly to the video to you via email for everyone who is in attendance today. And if you all do have questions, if you could refer to your GoToWebinar toolbar, there is a chat section there. If you could just enter your questions anytime you think of them during the presentation, and we'll go ahead and address those at the last 10 minutes of the presentation for Tracy to answer for you. That would be greatly appreciated. So I'll go ahead and hand things over to Tracy now so that she can get started. Tracy?
Yes. Hi, everybody. Welcome to the webinar. North Shore Advisory, which is my company, has been increasing credit scores and supplying professionals with information about credit now for about 20 years. So we've been studying credit before credit scores were really that much in effect. So we know a lot about credit, and I actually just authored my second book called Credit Score Power, which is available now through our website and through all the major bookstores online. And we work with bankers, we work with CPAs, realtors, attorneys, and financial planners across the country, helping their clients by increasing credit scores and giving them advice based on credit about financial choices and anything that is related to credit, and helping them so that their clients could reach their goals, and whichever professional has referred them can do whatever it is that they're trying to accomplish, either get them financing or get them more money to invest in different mutual funds and stocks, or to help them to get a better tax consequence if they're trying to get short sales or going for foreclosure. So there's a lot of ways in which we help professionals and their clients in credit. Credit is a very complicated and interesting and continuously changing type of organism, I should say, because it's like it's alive. Everyone's credit is like a living entity because it's always in motion. So I'm going to give you a lot of really good information today about credit, and I'm sure you're going to have a lot of questions, which I will try to answer as much as possible. And if I can't answer them all today, you can always email me, and I can help you from there. But what we do is we increase credit scores, and we bill our fee based on our success. And if we feel that our process is not going to work well for someone, we don't accept them as clients. And we also give free advice to professionals about credit. So feel free to use us for any of those things if you need us. So the first thing that we're going to talk about is credit scores. Here we go. And you should see a bunch of different credit score names on your screen. So consumers and a lot of professionals don't realize that there are many different credit scores. So if a consumer is going online to get their credit score, let's say they're approaching the time where they're going to be looking for a property to buy or refinancing a loan, and they want to find out about their score, and they hear all this buzz around nowadays about scores because of the economy, and scores are so important. So they go online and they Google credit score by credit score. And a million different sites come up, and they get a site that looks good, and they order their credit score, and their credit score is 780, which is a fantastic credit score, and they think, wow, I'm doing really great. I can get this loan. I can refinance this mortgage. And they then go to the banker who pulls their credit, and their score is a 660, and they don't understand. What? How could this be? How could my score be a 660 when I just pulled it online and it was a 780? Is this banker telling me the truth, or is this some kind of scam? So it's very important to be able to educate clients that there are many different credit scores. So the first score we see on the screen is the Vantage score. Vantage is a score that was created by the 3 credit bureaus, Experian, TransUnion, and Equifax, and it was created to actually compete with the FICO score. Although most banks don't use it. I think the only bank that might use it right now is HSBC, and I think they use just the Experian Vantage score. And it might be just for business banking, but it's not really popular in terms of banks who are evaluating consumers for a mortgage. But the Vantage score ranges from a 501 to a 990, and it has letter grades. So if you compare that to the FICO score, which is the score that most lenders use, the FICO score ranges from a 300 to an 850. So right away you can see there's a huge difference. 300 to 850 and 501 to 990 is not comparing apples to apples. And then on top of that, the Vantage score has the letter grade of A to F. So usually when we see a Vantage score, it's about 100 to 150 points higher than a FICO score, which is exactly what I was just talking about in terms of that client went online, bought the Vantage score, thought they had a 780, went to the banker pulled a score, and it was a 650 or a 670. Very different from what the FICO score is. So when a consumer talks to you about a credit score, that they might have ordered one and they know their credit score, the first thing you want to say is, what score did you pull? And if you don't hear anything on the other end of the phone, or if you're in person and they have like a glazed look in their eye, then you know that they don't know what score they pulled. Plus scores range from a 330 to an 830. They were also created by the credit reporting agencies, and they're sold to consumers for educational purposes and also for the bureaus to make money. And that score is about anywhere from, I would say, 10 to 50 points higher than a FICO score. So that's even more confusing because it's closer to the FICO score. And as we all know, the difference between a 740 and a 690 on a FICO score could be the difference between being approved for a loan and being denied. So it's very important that consumers are clear as to what credit score they pulled, especially if they're calling you 6 months before they're ready to go and look at a property and they don't want you to pull their credit at that point. If they don't have the right score, then they're going to believe they have a really good score when they actually may not. So you want to educate them that there are many different credit scores. There's also Equifax credit score, Credit Karma score. All these scores are different, and the one thing that's so important to be focused on is that the FICO score can only be bought through myfico.com, my.fico.com. Actually, I'm sorry, it's myfico.com. It's myfico.com. Now, to make things even more confusing, if you're not already confused, MyFICO if a consumer goes to MyFICO to buy their credit scores and credit report, it's usually about $20 a piece, and they cannot get their Experian FICO score directly from anywhere. The only way they can get it is to get it through a third party, like you, bankers, realtors, whoever it is that's pulling their credit. But they can't get it directly as consumers because a couple of years ago, Experian went to FICO and said, we would like to make some money from all of this profit you're earning by selling our information directly to consumers online. And they negotiated for a while, and FICO finally decided to tell them that they would not allow them to get any profit from the site's profits, and Experian decided that they would no longer allow FICO to sell their information. So unfortunately for consumers, they could only get 2 of the 3 credit scores. So they can get TransUnion FICO score, and they can get an Equifax FICO score. The good news is usually banks use the middle of the 3 scores. So if the Equifax FICO score is a 780 and the TransUnion is a 760, it doesn't really matter what the third score is. Because if the Experian score is a 550, it's still going to make the middle score very high. So if they want to go and order their own credit scores, they should understand that if the 2 they order from MyFICO are very different, one's a 780 and one's a 500 or 650, then they really need a third party to pull that Experian FICO score to see where they're at. So it's important that consumers understand that if they don't go to myfico.com, they really are not getting the score they need to judge what risk level they're going to be when they go for the mortgage. And again, I can answer any questions later on. Usually there's a lot of questions when I'm speaking directly to bankers and educating them at this point, because there's a lot of questions about scores online and the confusion. So if you have any questions, make sure to write them down and we'll come back to them later. Preparing clients for a loan. Why should we prepare clients way in advance for loans? And I think what that really means is for bankers to talk to their real estate companies that they deal with who send them business or any referral sources and try to give them tips on credit, because the sooner the client can get their credit in order, the more graceful of a process the loan officer or the banker is going to have when they get involved. And as we all know how difficult it is for loans to be approved these days, the sooner you can give this information, the better. We actually have a list of tips on credit that come in a PDF form, which you can send out to your clients or to your referral sources so they have this information right from the get-go. I also write articles about credit, free articles that go out to professionals across the country every 2 weeks, and you can also get those articles. So these are great ways for you to learn exactly what's going on with credit right now and to give that information to the people that are going to make a difference in terms of the clients you're getting. So I'm going to give you an example of what happened to somebody who didn't really understand how their credit worked, and they weren't prepared correctly for the loan that they were going to get, which they had a lot of trouble with. We had a couple who lived in New York City, and they were shopping for a mortgage because they were buying a condo. It was a very expensive condo, as most of them are in Manhattan, and they needed a $900,000 mortgage. So they were very excited about this new condo that they were buying, and they were at Bloomingdale's, and they saw this wonderful rug that they wanted to purchase for the property that they were going to buy. And Bloomingdale's had a special where if you opened up a card, you would get 30% off. And they wanted to do this. So this couple who had a 742 middle score and a 745 middle score, which was a very good score, but right on the threshold of the 740, which changes, as I'm sure everybody I'm talking to knows, when you go below a 740 with certain loans, it could be very difficult to get the loan or the best rate. So they decided to open this Bloomingdale's card, and because they opened this card, their scores dropped 50 points. And they were no longer able to get the loan they wanted with the interest rate that they were looking for. And it wound up costing them thousands of dollars a month more to get the loan that they wanted because their interest rate increased because their score dropped so much. Now, in today's market, it might have been a rejection for this loan. So just knowing that opening and closing credit could drop your score up to 60 points, and giving clients or potential buyers who you're just talking to way before they're even looking for a property, to give them this information and educate them could be the difference between you closing a loan for them saving millions of dollars or hundreds and thousands over the life of their loan, and it could be the difference between them giving you referrals because they're so happy they got such great information from you. So there's so many little things that can be done and also that can be done wrong that could hurt a loan. So when you're preparing a client for a loan, you want to go over certain things, and you also want to understand these things yourself. So the first thing that is very important in today's economy is having enough credit. And I'm sure many of you see clients that come to you that might even have really high credit scores and they only have 2 accounts on their credit report, which is very rare, but it does happen sometimes. So most of the banks that we deal with, they want a certain amount of trade lines. And everyone that I'm talking to right now knows what their bank's amount would be for which type of loan they're looking to get approved. The problem is most consumers who don't have a lot of credit, by the time they get to you and they're ready to get this loan, they can't get the home that they want, or they can't refinance the mortgage they want if they have a lack of credit. So it's very important to let consumers know way in advance that they need to build their credit up a couple of years before they go for a loan, depending on what kind of a loan they're looking for. If they have only authorized user accounts, they're not going to be able to get many loans out there today because they have to have primary lines in their name. So that's one thing that consumers need to know. Build good credit as soon as you can, as young as you are, so that by the time you're ready to go for a mortgage, you have many accounts in your name and they're aged. Because we know that banks want to see seasoned credit, anything that's a year to 2 years old, which brings up another really good point. If somebody opens a new account and the score drops, because new credit means you're a higher risk, the score wants to know you can manage credit and you can manage it for a long time. So when you open new credit, you immediately get a score drop. Now the way credit works is the higher your credit score, the more it drops when something happens like late payments, opening, closing accounts, collection accounts, charge-offs, tax liens, judgments, child support, late payments on student loans. Any of these events that occur, short sales, if this happens 2 days ago and it's updated on my credit report, if I had, let's say, a 780 credit score, my score could drop 60 points from opening and closing an account, one account. So If I have a 680 credit score, my score is not going to drop as low as it would if I had a 780 credit score because my score is already showing I'm a higher risk. So it doesn't have to reduce that much further to show I'm even higher of a risk. But when you're at a very high score, the only way the score is going to really see the new risk level that you're at when you open a new account is to drop it much more. So a 780 is going to now come down to a 720. A 680 may come down only 20 or 30 points. And this is how it works with all negative information. If you have a new late payment and you have an 800 credit score, you might see your score drop over 100 points. If you have a 630 credit score and you have a new late payment, it might drop 20 to 30 points because you're already a high risk. So timing affects the credit scores dramatically. The more recent negative, the more the score drops. The higher the credit score, the more the score drops. So people with very high credit scores have much more to lose when they have negative information than people with lower credit scores. So it makes it even more important for you to let your clients know who have the very good credit scores that are, let's say, 750 or 760, and you need a 740 to get the loan approved for this particular person. They need to know they can't open or close any accounts. They have to be very careful with making payments on time. If there are any accounts on their credit report that they've co-signed for and somebody else has control of making the payments, they want to make sure that they make those payments on time and know that they're made prior to getting the loan with you, because if somebody else who they co-signed for has a bad month and they don't pay that bill on time, it's going to dramatically affect your applicant's credit score. So all of this information is very important to let your potential applicants know way before they apply for the loan, as soon as you can. Now, the other thing that's really helpful, I'm just going to move the screen because we're talking about actually building great credit scores and having excellent credit. So what's really important in terms of credit and making sure someone has great credit is also seasoned credit. The older the credit, the better it is for the credit score. So many times bankers will pull credit and the client sees the credit and they see these accounts. Oh my God, that's not my account. You know, I want this off my credit report. I don't recognize that account. And these accounts are all like 20, 25 years old. And maybe this person has the same name as their father or a relative. And all these accounts that are sitting on their credit report that aren't theirs are not open anymore, but they're very old. The fact of the matter is those accounts are adding a significant amount of points onto that person's credit score. So sometimes we find these people come to us and they say, I want to remove all these accounts. They're not mine. I don't want them on my credit report. And we notice that the few accounts that are theirs have negative information. And if we were to remove all the good accounts, they would really be in a much worse position. So it's very important to make sure you really evaluate the full credit report before someone decides they want to remove old information. And this brings up another really good point. A person may have good credit and a score that just isn't quite making it. So if they go on to an authorized user to their parent or their girlfriend, husband, wife, whomever, their credit profile, their credit card, an old credit card, a 20-year-old credit card, they're put on as an authorized user. In 3 to 6 months, that card will come on the credit report. That could boost the credit score anywhere from 30 to 60 points. Even though they're an authorized user and not a primary, the score will still boost. So if you're looking at a credit report for somebody who is just first beginning to go and search for a property, and you see that their credit score is in the 680s. They have good credit, but they don't have old credit. Let's say it's 3 or 4 years old. And they have some time to be added on as an authorized user onto somebody's old credit card. They can go ahead and do that, and the score will increase. There was a time when they were trying to stop authorized users from having extra points on the credit score, but that was never approved by FICO, so it still helps to increase the credit score. If you were looking at the Vantage score, which is something that isn't used by banks, the Vantage score would not have higher scores because of authorized users. So that score does not view authorized users and give them extra points, but FICO does. So it's a great trick for increasing the credit score on somebody's credit who maybe is young. They have good credit, but it's just not old enough. So the older the credit, the better it is for the credit score. Aged credit is like a treasure to the credit score. And this is another reason why you do not want to close accounts. Besides the fact that you're taking away a good account, after 2 years of inactivity, credit can drop off the credit report. So if you have an American Express card that is 10 years old or 15 years old, it was opened 15 years ago, and you closed it 3 years ago, and it drops off the credit report 3 months before you're applying for a loan, that could be the difference between being approved for the loan or paying a much higher interest rate because the score drops dramatically. And we've seen this time and time again. We'll see like a client who has one credit score that's a 780 and 2 credit scores for, let's say, Equifax and TransUnion that are in the high 600s or low 700s, and the only difference is on the Experian, there's an American Express card from 25 years ago that's not showing up on the other 2 reports. So this is very important, not to close old credit. The other thing that affects the credit score is if you don't use your credit for a year, scores can drop 20 points. So we see this a lot in the last year or two because a lot of consumers want to use one card to get the extra miles or points. So they use their one card for everything. And they have 4 other cards that they just don't use. And after 7 months to a year, I would say, the scores drop 20 points for inactivity of credit. When you pull a merged credit report, if you look under where all the scores are, there's usually like 4 or 5 sentences that tell you what the worst events of that particular credit report are that are affecting the score. And you can see inactivity of credit. Sometimes usually you see it on high credit scores, like in the low 700s. If somebody might have been using all their credit, instead of a 725 credit score, they might have had a 745 or 755, which could be a significant difference in the interest rate or even in being approved for the loan that they're applying for. So inactivity of credit happens often, and consumers should be educated that if they don't want to use all their credit cards, they should at least use each credit card for 2 to 3 months a year so that they remain active, and also so that the creditor does not close the account. Because creditors these days, if you don't use the account for a year, they will actually close it on you. They'll send you a letter saying that the account has not been used for a year and they are closing it. This is very important to explain this to consumers and also for your own personal information. Besides the fact that closing credit hurts the credit and inactivity of credit hurts the credit, if you have credit that's opened and you have the ability to use that credit, once it's closed, you're losing a tool. And if something were to happen and a person lost their job, there's no longer a way to get that credit opened, especially nowadays because a lot of creditors want to see proof of your income to give you a credit card, to approve a credit card. So it's very important that consumers understand that keeping credit is going to help them. And once they close it, they're damaging their ability to get credit, and they're damaging their credit score. And if they don't use their credit, they may lose their credit. Very important tips when talking to consumers and for yourself personally. When credit closes, it can drop off the credit report within 2 years, and that could significantly affect the credit report. So that brings me to the average age of credit. Average age of credit means all your credit together, what the average age is. If I have 10 accounts that are 15 years old, and I decide to open 3 new accounts this year, my average age of credit is going to reduce significantly because I have 3 baby credit cards now. So not only am I hurting my credit score because I'm opening all these accounts, but I'm also reducing the age of my credit, which is significantly dropping my credit scores. It's going to take a lot of time for my average age to get as old as it was before I opened these 3 new credit cards. So it could take many years for my score to go back to where it was. So it's very important to time opening new credit at the exact right moment, since if I'm going to be applying for a loan in a year from now and I decide to go and open 3 accounts, that's going to reduce my credit score significantly and change my monthly payment on that mortgage. Could be for the next 30 years. So this could cost me a fortune of money. So timing is very important when it comes to credit. Opening and closing credit has a big effect, not only on the credit scores just because opening and closing credit drop scores, but also because it's changing the age of my credit. If I close an account that's 15 years old, it drops off my credit report in a couple of years, and the rest of my credit is 8 years old. That's going to significantly change my credit score just because I lost that old account, besides it dropping my score because I closed it. And again, opening credit is also going to significantly change my credit. I want to talk now about inquiries, which is always a very confusing topic to professionals, bankers, and everybody. So we talked about that, inquiries and the varying windows that banks use. Inquiries, third-party inquiries, meaning when a credit card company reviews a consumer's credit to increase a credit limit or to approve an application for a credit card, not a promotional offer from a credit card company. That is not an inquiry that hurts credit, which is a hard inquiry. That would be a soft inquiry, and soft inquiries do not drop the credit score. Soft inquiries include promotional offers and every time a consumer pulls their own credit. So a consumer can go to the MyFICO site 50 times in one day and buy their credit scores, and it will not drop their score at all. So when your clients are fearful of pulling their own credit, you can educate them and tell them it's not going to hurt you. You can pull your credit as much as you want, anytime, and it does not show up on the credit report as a hard inquiry. It will not drop the score. Hard inquiries are when third parties pull the credit report, meaning bankers, car leasing companies, realtors, student loan financing companies, credit card companies. when they're increasing the limit or approving a consumer after they apply for a credit card. These are all hard inquiries. They drop the score anywhere from 2 to 5 points. The difference between banking inquiries and credit card inquiries are consumers have a certain window of time to shop for a mortgage, a car, and a student loan, that they are allowed to have their credit pulled as many times as they would like, and it only counts as one inquiry. So that time frame is 1 to 14 days. These days, the windows that most banks choose are 14-day windows. It used to be 30-day windows until the economy changed. And before the economy changed, they wanted to hike it to 45-day windows. But when things got bad, they got more conservative and more rigid, and they reduced the window down to 14 days. So, for example, if I'm a consumer and I go to Wells Fargo on day one and they pull my credit, and then I go to Bank of America, HSBC, Chase, over the next 10 days, every 2 days, it is only going to be viewed as one inquiry, and it will drop my score 2 to 5 points. Once that 14-day window ends, and I start shopping the week following that 14-day, and I have my credit pulled by a broker, that's going to be another 2 to 5 points. So this is very important that consumers know if they are going to shop around for a loan, they need to do it in a very short period of time. Now, the good news is, from what I believe, and I'm not a banking expert, most banks use the credit report that's pulled for 90 days. So whatever happens after that day one, if that consumer is using Wells Fargo for that loan, and Wells Fargo is using the credit report they pulled day one, then even if they did go and had many inquiries over a period of time, it's not going to affect that particular loan. But consumers should know that if they do want to shop for a loan, they should have their credit pulled within the shortest period of time by as many lenders as they are going to shop to for that loan application. They also need to know not to go and get credit limit increases, not to apply for credit cards, because of course they're going to have a new opened account that's going to drop their score, and also they'll have the inquiry. And this is extremely important. Now with us, what we do is we remove and change information that's hurting the credit score. We give advice about what balances should be paid down. You know, we'll look at a credit report and tell you which balances the consumer should reduce and how much they should reduce it to get to the score that you're looking for. So we can actually review each credit report. We give free advice to bankers, and if a client wants to hire us, we keep you in touch with everything that's happening to increase credit scores. And we're able to increase credit scores hundreds of points, in many cases within sometimes a week or two. It could take 2 to 3 months, but it depends. Each case is different. So balance to credit limits. It's one more thing I want to talk about, because we're getting close to the end here. But balance to limit ratios. There are different types of credit, as you know, on credit reports. There's revolving credit, which is anything you can pay the minimum and charge up to the limit. If your credit report doesn't show a limit, but it shows a high balance on a revolving account, that high balance is viewed as the limit. So if a consumer has a balance that's over 7% of the limit, they're going to lose something. They're going to lose some amount of points on their score. We usually tell people try to get balances down to 10% of the limit. If they need every little point, if they need like 2 points, then we would tell them 7% of the limit. As the balances increase and get closer and closer to the limits, the score drops further and further. So if you have a balance that's $2 from the limit, the score could drop up to 100 points. It's very sensitive to balances. Now, the other thing that's interesting is the score tabulates the risk level based on two different types of balance to limit ratios. The first is the individual account balance to limit ratio. So for example, we see this often too. If a consumer has a Victoria's Secrets credit card, which has a $500 limit, most of them are very low limits, and they have a $490 balance, that is going to negatively impact their credit score because that particular account, the balance to limit ratio is very high. It also goes by the aggregate balance to limit ratio of all of the revolving credit. So if there are 30 accounts and they all have $10,000 limits, and that's a $30,000, no, so let's make it simple. 10 accounts with $10,000 limits, it's a $100,000 aggregate limit. The aggregate balance, if it's over $10,000, is also going to affect the credit score. So these two types of balance to limit ratios affect the score. Now sometimes we see consumers who have 3 or 4 accounts that don't have any balances and have high limits, so their aggregate is good, balance to limit ratio, but they might have a few little accounts that are very close to the limit, and that is affecting the credit score. So it's important to make sure that the limit and the balance are the right ratio, even if the aggregate works. If there's a small account that has a balance that's close to the limit, it's going to affect the credit score. So we want to make sure that consumers know that it's those two types of balance to limit ratios that are affecting the credit score. And sometimes consumers will say, well, what if I raise my limit and increase? It'll increase the limit so the balance to limit ratio is better. But this is really a dangerous game because first of all, you're going to have an inquiry because the creditor is going to have to pull the credit to see if they want to give you that limit increase. And second of all, if your balances are high, that could draw attention and the creditor could actually decrease your limit or deny you for that limit increase, and now you're left with this inquiry and a drop in the score, and you're in a worse position than you were in the first place. So I don't recommend, unless if I viewed the credit report and I thought the person would get the limit increase, then I would approve it. But for the most part, people who are looking to increase their limits just to get the better score because they're having problems with paying down the balances usually have higher balance across the board. And that usually is going to cause a rejection of a limit increase. So it's not the greatest idea to do that. Just looking to see if there's anything that I want to review that I haven't discussed. Oh, what's very interesting and isn't on any of the pages of this program is something that happened recently with taxes. So this is something that could be a great tool for you when you're trying to close FHA loans. In 2011, the IRS decided that they were going to do everything they could to get consumers to pay open tax debt. So federal debt, if consumers have tax liens that are under $32,000 on their credit report, and they go into a payment plan with the IRS where payment in full is the end result. So this can't be a settlement on tax debt. It has to be a full payment as the end result. Or if they plan on paying it in full in one lump sum. Before they apply for the payment plan or to pay the full payment, they need to request from the IRS a withdrawal letter. The IRS will then allow them to go into this payment plan where they're automatically debited from their bank account the amount that they agree upon on a monthly basis within a period of usually 3 to 6 months. The IRS will allow the withdrawal letter, and the public record will come off that consumer's credit report. So as of right now, consumer with a federal tax lien under a certain amount of money, as I just discussed, who is not fully paid to the IRS can have that tax lien removed from the credit report prior to full payment so they can be approved for an FHA loan. So this is a great tool for bankers. Most people who are going for FHA loans, they're using their money as a down payment on the property, and if they have to pay the IRS the tax lien to be approved for the loan, then they don't have the money for the down payment. But because of this change with the IRS, now consumers could get the liens removed from their credit report prior to payment in full and be approved for the loan. So this is a fantastic tool for you to use when you come across people with open tax debt. Now, I wrote an article about this that was in CPA Journal, I believe, a month or so ago. I write articles all the time for professional journals, and it's actually on my website, the article. And if you click on the article, it gives you more details on exactly how a consumer will go about doing this. And in some cases, it doesn't automatically come off the credit report, but we can always help it along. If the consumer does not see it being removed, they can hire us to remove it, but it should be removed from the credit report. And I think that it's time to wrap it up. I just want to see if there's anything else that I wanted to discuss with you. We do have here security freeze, pulling credit. When somebody has a security freeze, I'm going to go over this real quickly. When someone has a security freeze, it's like the worst thing when you're trying to get a loan done, or if anyone is trying to pull the credit, because you're not allowed to pull credit on a consumer when there's a security freeze. So if you can't get a credit report and a score from the Bureau, the best thing to do is ask the consumer, did you put a security freeze on your credit? Sometimes they don't even know they did. But if they did, they need to get a PIN number, which they should have or they can get from the credit bureaus. And they give you that PIN number, which you then give to your pulling service. Your pulling service then uses that code, and it stops the freeze for you specifically to pull the credit report. Security freeze is just such a cumbersome type of thing to have. At this point, the consumers don't need it. They can have a fraud alert where they put their phone number on their credit report, and creditors have to call that consumer on their phone number to approve credit before allowing a new account to open. So there's really no need to have a security freeze on the credit report. It just causes a lot of problems. But there is a PIN number that the consumer should have to give to you if you're going to be pulling credit for them and they have a security freeze. I've spoken for a very long time. I definitely need a glass of water, and I'd love to hear your questions. It's 10:02, so I'm going to open it up, and we'll take it from here.
Perfect. Thank you so much, Tracy. You gave a lot of very, very valuable information that hopefully a lot of people will be able to take back with them and use for the future. So we definitely appreciate you being here with us today.
My pleasure.
We do have a lot of questions here, so I'm just going to go ahead and jump right into it.
Okay.
Just let me start off with the most basic one. A couple of our attendees mentioned that you said that you had a website in which you wrote your articles. Could you provide us with the website address so that they can visit that?
Sure. It's northshoreadvisory.com. So northshoreadvisory.com. advisory.com. And there's a newsletter section with all the articles I write for professionals. There's probably like 70 of them. If you shoot us an email from the website, the articles will go directly to you every 2 weeks. There's a new one coming out next Tuesday. So shoot us an email. We'll put you on the newsletter section, and you'll get them automatically. And then there's the press page, which has all the professional articles, the one I was talking about, that speaks about the IRS process.
Perfect. Great. Sounds good. Okay, let me jump into the detailed questions here. Wayne starts off with asking, how does having an identity theft service or company affect your credit score, if it does at all?
Okay, so if you're talking about a credit monitoring product, I think that's what you're talking about. That has,
yeah, that's what it sounds like.
Yeah, if it's a credit monitoring product, we actually have our own credit monitoring. We offer it to our clients, and it's used by a lot of CPAs who want to give their clients concierge credit monitoring services. But credit monitoring is not going to hurt your credit, but it does cause a lot of confusion, because what happens is people are alerted when they have inquiries, they're alerted when their balance increases to a certain number, and a lot of consumers don't understand why they're alerted because they don't know how to use their product. And they wind up getting scared, and some of them close accounts thinking that there was ID theft, or they just panic and they go through a lot of trouble to figure out what's going on because they don't understand how to use the monitoring product. And it becomes like more of a problem than an asset. But in terms of your credit report, it should not affect your credit score at all.
Okay, perfect, great. And he also follows up, I guess earlier you had mentioned something about short sales. He wants to clarify, I guess, in the views of credit rating systems, is a short sale considered as a foreclosure, or is that
a short sale? It's very interesting, and FICO came out with some really amazing information there. Everything's a secret with them, but they came out with some amazing information recently. A short sale is considered a settlement. It's like a, you know how you see settled for less than full balance on the credit report? That is what a short sale will come up as, because that's exactly what it is. It's a settlement. So I'm going to give you an example. If a person, consumer C, starts out with a 780 credit score, and they have a short sale, which will show up as a settlement, with no deficiency balance, their score will drop from a 780 to a 655 up to a 675. So it's going to drop over 100 points. It could drop like 120 points. And it'll take 7 years to recover from that if it stays on the credit report. And we work on short sales before the 7 years is up, and we can work on them 2 years after they happen and try to remove them from the credit report. If consumer B, who has a 720 credit score, has a short sale with a deficiency balance, their score will drop anywhere from a 570 to a 590. Okay, so that's going to drop the credit score significantly, but not as much as it would if it was a 780 credit score, and it also would take 7 years to recover from. This is the interesting part. If consumer A, who had a 680, has a short sale, their score is going to drop to a 610 to 630, which really isn't that much more. You know, it's not a lot considering, and it'll only take 3 years for the credit to recover back to the 680. So it's very interesting how the time changes with the different scores and how easier it is to recover when you have a lower score than when you have a higher score. If the short sale has a deficiency balance, the scores will drop actually about the same. It's about the same either way. Maybe a little bit more. It'll be a little bit more with the deficiency balance than without it. So the 780 goes down to a 620 to a 640. So it's like anywhere from 15 to 45 points more. The 720 goes down to the same thing, 570 to 590. No, it goes to 570 to 590 with the deficiency balance. It was 605 to 625. And the short sale with deficiency balance at a 680 goes to 575 to a 595 instead of a 610 to a 630. And the recovery period is the same either way, with or without the deficiency balance in terms of the credit score. So short sales are viewed as settlement accounts paid for less than full balance.
Gotcha. Great. Thank you so much for clearing that up. And Wendy asks, after the 14th day, is it 2 to 5 points, I guess, is a penalty for each inquiry or inquiry?
Mm-hmm.
I'm sorry.
Yes,
okay, so that is
it's
true.
2 to 5 days. But the scores also look for bunches of inquiries. So if you had a 14-day window where there were 10 inquiries within that window, it would be 2 to 5 points. And then if 3 weeks later you had another 14-day window with 10 inquiries, that would be another 2 to 5 points. So if the consumer was having their credit pulled every 2.5 weeks once for a period of 5 months, it could be a big drop. So bunches of inquiries within a 2-week period are viewed as 2 to 5 point reductions.
Okay, great. And Kristen asks, which one weighs more on the credit score, the aggregate credit limit to balance or the individual, or do they have an equal weight?
You know, it's a good question, and I can't answer it. I don't know. I can't tell you which one weighs more. I can tell you that if you can get the balance to limit ratios at 10% or 7% of the limit on each individual account, you'll be at the aggregate. So it'll work for you. It's better to have the individual accounts at 7% of the limit than the aggregate. That's what we have found in our experience. But I'm not telling you this based on anything I've read. It's just our actual experience.
Okay, great. And Herbert would like to know, what are the best ways, in your opinion, to reestablish your credit after bankruptcy?
After, you know, it's funny because there's so many credit cards that people can get like a day after a bankruptcy because they're less of a risk than people who haven't had a bankruptcy because they're not going to be going to bankruptcy so soon. But you can go to a site called credit.com, and on that site they have a list of all kinds of types of credit cards for specific kinds of consumers. So I think it's on the left side of the site, and it says on the site, bad credit, no credit, bankruptcy, miles. You know, it gives you all the different categories of types of credit cards that you're looking for, and you click on the category, and it'll tell you the names of each credit card, the rating of the credit card, and you can actually read the fine print, the terms on that particular credit card. So it's a good site to shop for credit cards. So after bankruptcy, I would go and get myself some credit cards, maybe a couple of secured credit cards. If I couldn't get a card that wasn't secured, I would put myself on as an authorized user to somebody's old, really good credit if I had somebody that, you know, was available to me that would allow me to do that. And I would start using my credit and not paying it off every month. Keep a little bit of a balance and pay early every month. Keep a small balance. Do that over a 6 to 7 month period. After about a year and a half of having 2 secured credit cards and an authorized user card, I would then apply for a regular credit card. I also would have the person call us a year after the bankruptcy is over and inactive, and then we can work on cleaning up the credit. It's actually the longer they wait to hire us, the better it is. So if they can wait 2 years, we'll have more success. And we could do amazing things for somebody like that. We can clean up their credit. They can have excellent scores within, I would say, 2 to 3 years after the bankruptcy if they follow what we tell them to do in terms of building credit, and we're able to remove and change information. It could be a dramatic effect. I also just wrote a book which helps people to understand how to build their credit, and that's also available on the website, on the press page, and it's at all the major bookstores. You can find it online to download as well.
And what's the name of that book again, Tracy?
It's called Credit Score Power, and it has a lot of the information that I just gave you.
Okay, great.
One of the
Thank you so much.
differences is it's the 7% of balance to limit ratio. It was 10%, it's now 7%, so that you should remember, the 7%.
Okay, great. And could you do me a favor in the presentation? Could you just bring up the last page that has the contact info on it, just in case?
Oh, sorry.
We're running out of time. That's okay. No, no worries. I'm just going to hit one more question because we are running out of time. So if any of you have any questions or anything, please feel free to email the email address webinars@coesterappraisals.com, and we will have Tracy receive your questions and reply back with an answer, just so that way Tracy doesn't get bombarded or get everything, mixed up. So we'll go ahead and send those through to Tracy and get your questions answered if it hasn't been today. So I'm going to bring up this one last question.
Sure.
Erica would like to know, can a consumer request that their credit card companies report the actual credit limit rather than the historical high balance to improve their balance to limit ratio?
They could request it. I don't know if the creditor is obligated to do that, but there's no harm in requesting it. Unless the person has a late payment on their with the credit card company that's not showing up on the credit report, and if they go to request the limit to be placed on the credit report, and then the company puts their whole history on, and there's a new late payment because of it, I mean, that does happen to people. They want something changed on their account, and they ask the creditor, and the creditor then updates everything, and there might have been a late payment that wasn't reflected on the credit report. So you have to be careful when you're asking creditors to update information on credit profiles. But yes, there's no harm in requesting the limit be placed on there if it's better than the high balance.
Great. Perfect. Well, thank you again, Tracy, and to all of our listeners. This webinar has been recorded and will be available within the next 48 hours. We'll go ahead and send you a direct email with that along with Tracy's website so that you can retrieve more information and read articles that Tracy has published and order her book if you are interested. So we'll go ahead and send out all that information in one email for you. And we appreciate you being here today with us. And thank you once again, Tracy, for your expertise.
My pleasure.
We really appreciate it. And do you have any final words or anything else you'd like to add before we go?
Just send me any questions you have. We'll be happy to help you. If there's any credit reports you want a response to, we don't charge to give you information, and if there's something we can help you with, we want to do that. So feel free to send any questions, and I appreciate everybody listening in.
Thank you so much, and everyone have a great day. You too, Tracy.
Bye-bye.
Bye.